financial plan is the most important part of a business plan. Any entrepreneur that failed to create a financial plan fail, which is the reason why creditors and investors ask for a legit financial plan before putting their money into a startup business. A clever entrepreneur will use a financial plan as a competitive advantage because it's one of the sources that other competitors don't have access to. According to Sage North American survey report, 23% of small business owners lack financial literacy, which is one of the main reasons why their company fail. 75% of business owners fail to focus on financial details of their company. Balance sheet, income statement, and statement of cash flow are used to measure a company's financial position.
Balance sheets provide business owners their company worth on a given time, and it's prepared on the last day of the month. Some describe the balance sheet as a snapshot of the company's financial position at the point in time. It also allows creditors to see what the company owns as well as what they hold other people. And it contains information that banks use to determine whether the company is qualified for additional credit or loans. The balance sheet accounting equation is assets equals to liabilities plus owner equities, which is also means stockholders. Any increase or decrease in the assets will offset the liability and vice versa. Assets are things that the company owns. They are the resources of the company that have been acquired through transition and have future economic value that can be measured and expressed in dollars, which also include the prepaid, like the prepaid advertising, prepaid insurance, prepaid legal fees, prepaid rent, etc. The assets part of the balance sheet consists of current assets, which is converted into cash, and fixed assets, which are required for long-term uses. Liabilities are the company's obligations, which is the amount the company owed the creditor for the past transaction, which also include the amount of money the company received for advanced future services. Payables is the word that is associated with liabilities. The liability section has current liabilities, which are debts that had to be paid before the end of the year, and long-term liabilities, which is due after the year. This is an example of a balance sheet. It's divided into two sections, assets and liabilities. Both sections offset each other, in which they have to be the same amount for the account to be balanced. Income statement, which is also known as the profit and loss statement, is used to report a company's profit during a short period of time by comparing the company's expenses against the revenue to show the net income or net loss of the company. The revenue are the amount earned through the sale of goods. Expenses are cost of goods sold and general expenses like advertising expenses, interest expenses, sales and marketing, payroll tax on stock option, and research and development. In order to find the net income, the company will account for all operating expenses, including taxes. Then for the dividends that was paid out, and the net income would determine the success of the company. This is an example of an income statement. We started off by finding the net sales, then the cost of sales, the gross margin, operating expenses, operating income, and that will give us the net income. Determine the net sales revenue. Owner have to subtract the value of return items and refund from the gross revenue. Gross profit margin is a ratio that every business owner should pay close attention to. Company gross profit margin is too low. It's likely that the company will operate at a negative net income. It also measure how much of every dollar of revenue is left over after paying cost of goods sold. Companies that have low gross profit margin will have the tendency to increase prices, cut manufacturing and purchasing cost in order to repair their gross profit margin that was low. The statement of cash flow is a financial report that describes the sources of a company's cash and how the cash was spent over the period of time. It does not include non-cash items like depreciation. Most small businesses don't prepare the statement of cash flow. They rely on they rely on cash budget, which is an estimation of cash inflow and outflow for a business at a specific period of time. Business owners have to use information from balance sheets and income statements in order to create the statement of cash flow. In creating a projected financial statement, business owner must have enough capital for starter costs to cover buildings, inventories, furniture, license, and even to pay employees. They also need a reserve capital until the business generates positive cash flow because the business will most likely not make the profit for the first year or some few months. They also need the reserve capital to cover expenses like utilities, advertising, and depreciation. Financial dashboard helps business owners to see the vital sign of their business. It helps them to avoid becoming a failure statistic by showing them the number that drive their business. When the business is up and running with the help of a solid financial plan, the next step is to keep their company moving in the right direction with the help of a solid financial controls. Applying financial control is one of the key of keeping a business healthy and successful. Ratio analysis is a method of expressing the relationship between any two elements of financial statement, which provide a technique for performing a financial analysis. Ratio analysis is also used to identify problems in businesses. Lenders and investors use ratio analysis to analyze the financial statement of companies that's looking for financing. and comparing them against company average. Ratio analysis also help entrepreneurs to determine whether the company is carrying excessive inventory or experiencing every operating. The 12 key ratio that helps most business owners to monitor their company's financial position without becoming bogged down in financial details, which are the current ratio, the quick ratio, debit to net worth ratio, and time interest earned.